Thanks for tuning in to yet another episode of Where Do Millionaires Invest? If in the previous episode you heard Edelweiss Wealth talk about how private markets are at the center of their clients' portfolio in the alternatives side, our today's guest, Nitin Jain, who is the founder of Neo Asset Management, talks about how they are asking their clients to keep fixed income at the core and not just normal fixed income, alternative fixed income.
After building one of probably the largest wealth and asset management practices in the country and selling it to one of the largest private equity companies in the world, finally the entrepreneurship bug has bit me. I'm starting off a new franchise called Neo. It's going to be a premier new age financial services firm, which is going to hopefully build some of the finest solutions for our clients. We are going to be driven largely by fixed income and alternatives.
So there you heard Nitin Jain, founder of Neo Asset Management, talking about why is it that they are slightly different in what they are doing. Now let's try and figure out from Nitin, how does he believe his clientele, current and future, will think about investing differently, and how is it that they are advising them in the current times, and what does he see the future to be like? Nitin, great having you.
Thanks you for so much. Yes, such a pleasure.
Yeah, such a pleasure indeed. So Nitin, let's start off. I mean, you have a very rich history of managing enormous amounts of wealth, and now you've kind of founded your own firm. What is it that is the core driving principle behind how you go about investing your clients' money or advising them on their money?
No, absolutely. So first of all, thank you for having me here. I think even in our previous avatar, as part of our earlier franchise, I was responsible for running one of the largest wealth management business. But in this practice, basically we are running two businesses. One is our multifamily office practice, and the other is the asset management. And in our multifamily office business, basically most of our clients are young entrepreneurs, young businessmen. And when we talk to them, the biggest need that comes across is they have created wealth. So it's not that as a wealth manager, I'm trying to create wealth for them.
Of course.
They have created wealth. So they are looking for wealth preservation, they're looking for some growth. And where we come into play is how to help them not divert their attention from their core businesses, take care of their wealth, help that grow. And our core focus always is about long-term asset allocation. I think a lot of people in the market tend to believe that product selection is the key driver of alpha. Mm-hmm. We have always stuck to asset allocation. If you can be very disciplined about asset allocation, long term your returns are always superior. So that's what we advise our clients around. The second key point that we focus on is diversification. Unfortunately, in India, still you cannot do a lot of diversification internationally because of all the issues around capital account, etc. But a lot of new products are now getting created, especially in the alternative space, which actually are which provide good diversification because the correlation with the existing portfolios are much lesser, and a lot of new supply of those fund managers are coming in. So using the alternatives piece, using the fixed income piece, and whatever little we can do internationally with the spectrum that is available, we allow and help our clients to diversify. So long-term asset allocation and diversification, these are the core principles around which we try and advise our clients.
So you're saying, in your experience, for whatever quantum of wealth there might be, asset allocation would be a bigger driver of wealth creation than a selection of products, so to say.
Absolutely. I mean, there are a lot of studies which are available, and most of the studies would indicate that 80% of the alpha in most portfolios can be attributed to asset allocation rather than either fund selection, product selection, or security selection.
Okay, wouldn't that be a part of asset allocation too?
It is. But let me give an example. You get a particular stock right. But the amount of money that you make is not because you got that stock right. It is about how much you bought, right? So for me, how much you bought is a more important decision than what stock you bought.
Got it.
So I think that allocation, capital allocation to individual decisions is probably a lot more weightage to our thought process than specific individual decisions.
Okay, and in this case, viewers, I think how you can differentiate is, I mean, purely stock market investing would be about how much allocation to make to an individual stock in the portfolio. In this case, it's about what allocation to a particular asset.
Absolutely, whether it's equity, whether it is debt, whether it is alternatives, whether it's international assets, and so on and so forth.
So, okay, what's the message that is, okay, let me actually first take a step back and then I'll try and figure out what's your current asset allocation, average asset allocation percentages, so to say. But a grain that I got from a couple of other conversations on this very series was that the ULTRA-HNIs and the really smart investors had, even if they didn't redeem, had stopped making large fresh allocations to equities per se, whether local or international, starting about December itself. So they have been kind of on the back foot only. Is that a sense that you got as well, that some of the really smart guys didn't quite put in the money starting December and were sitting on the sidelines?
Well, we'll know whether they were smart or not
of
only
course.
10 years out. But that's true. I think the markets were heated, no doubt about it. And I think even we were advising clients not to incrementally allocate for some time now.
Okay.
And some of these calls will go right, some of these calls will go wrong. But absolutely, I think it was reasonably evident to a lot of people, including us, that the markets did go into an overheated territory. And there were reasons for it. I mean, I think the kind of retail flows that you're seeing in the market, I think it's unheard of.
Of course.
I'll tell you some data which might surprise you. Around 3 years back. And I never thought this will happen in my lifetime, by the way. We used to see around 2.5 to 3 lakh demat accounts getting opened every month.
Yeah, sure.
So 2.5, 3 lakh new people getting into the stock market. This pre-COVID. And you know, you make projections, you think it'll grow at 10, 15%, 15%, 20%. Around 6 months back, there was a month where you were at 50 lakhs in a month.
Yeah.
So 3 lakhs per month to 50 lakhs a month. Now that I think is just a reflection of the euphoria in the market, right?
Sure.
So whenever that happens, I do think it's also a reflection of the great things that are happening in the market, but also a reflection of probably some level of over-optimism, if I can use the word, getting built in the market. And some of the clients, I would think, had become quite cautious.
Okay.
And we were also reasonably cautious in going into this kind of a phase.
So now from December until now, and let's focus on equities for a bit and then we'll try and focus on the overall asset allocation strategy as well. But since equities drive a large part of most people's portfolios, is there a change in how you think about allocating to equities now versus what you probably thought, let's say in December as well? Because the markets have come off. They can of course go down. I would love to understand how you're thinking about equities in general currently.
No, I think, as I said, I think we have some very simple rule-based frameworks. But one of the frameworks that we like a lot is looking at history and looking at earnings yield versus, let's say, the bond yield in any particular market. So, for example, at a Nifty level, if I have to look at the aggregate earnings today, I think the earnings yield will broadly translate into 5.5 to 5.75%. Whereas when you look at the GSEC 10-year, I think that'll be around 7.5. So the gap is around, so earnings yield is trailing by around 175 basis to the GSEC. And what we have seen that in the worst case scenarios, this has not gone, the spread has not gone below 100 basis point. Okay. So let's say the worst case was to play out, there is still a downside of maybe let's say 10% from here. Unless you're expecting the GSEC yields to move up much more and so on and so forth, which is not our base case hypothesis. Having said that, a 5 to 10% downside in equity markets is a given. So we are already, in my view, in a zone where some of the high quality stocks and some good high quality fund managers have become a fair game. So we are now definitely evaluating opportunities to add. We are currently slightly below AQ8, I would say, but we are looking to add at possibly every dip from here on the equity position. So can it go down? Of course. But just remember that our clients are not looking for returns over the next 1 quarter, 2 quarter. We are looking at generating returns over decades.
Sure.
So it's a slightly different world that we live in. But even from a 3 to 5 year point of view, my view is that I think the risk return is starting to become favorable. Can there be a 10% downside? Absolutely. But in equity, that I think we should make an assumption at any level.
Any level. Okay, so as I understand, while equity is one part, but you are obviously looking at a multitude of different products, asset classes as things stand. Can you first start off with the basic framework of, at the current point of time, for an average client, what is the asset allocation percentages, if I will? How much to equities, how much to fixed income, how much to structured products, maybe international? Can you tell us a bit about it?
Actually, it's very difficult to say that because Neeraj, the point is for every individual investor,
it's different.
It's bespoke, right?
But so, is there an average? Mota moti?
So I think it's fair to say the way to think about this is we are currently nearly equate on or slightly underweight on equities.
Okay.
Which I think we will correct over the next 1.5 months.
Okay.
We really like fixed income.
You really like fixed income?
We really like fixed income.
Okay.
I think we have got into a space, and we might be a little contrarian right now, where both duration as well as credit has started to look good. Can this go up a little? Of course. I mean, 7.6 can go to 8. But now you have to start thinking the risk reward. People were jumping over each other at 6.5 to lock in long-term yields.
Yeah.
Right. At 7.6, 7.7, I think the risk reward is so much better. Right. And the way to think about returns in fixed income is incidentally not very different from the way to think about equities. But I don't think there's same level of rigor in fixed income space yet as there is in equities, because there is so much research available in equities.
That's true.
But you don't get that kind of research, that kind of tools in fixed income. We also want to fix that. We want to come out with our own fixed income research and so on and so forth over a period of time. But today, I think there are a lot of very high quality fixed income instruments, high quality credit that is available, both in terms of duration as well as in terms of credit spreads, where we think we can create very high quality portfolios and over our next 3 to 5 year deliver maybe 10 to 12% return purely in fixed income. Now you match that vis-a-vis money lying in fixed deposits, which is probably generating 5.5%, 6%. So the gap over, and fixed income we generally benchmark versus FDs.
Of course.
So in FD, if you're making 5.5 to 6, and in fixed income we think you can deliver anywhere between 9 to 10, let's say. It's a 400 basis point spread. Now it's very, very interesting. So we think fixed income over the next 3 to 5 years is going to be one of the more interesting asset classes than what it has been over the last 3-4 years. And we are very focused on that. The third category is alternatives. And I think that is a category that I've been talking about for some time now. We were one of the leaders in my previous organization. Even here, we want to do a lot of work there. I think in the next 5 to 6 years, my view is that AIFs might become as big, if not bigger, than a lot of traditional mutual funds in terms of revenue pool for asset managers. So I'm distinguishing between the AUM and the revenue. Because obviously the AUMs are higher in traditional assets, the fee is lesser, whereas the fee is much higher on the alternate side because of much more effort that goes in. From a market size point of view, I think alternatives are going to grow much, much more than the mutual fund industry.
By alternatives, you mean the equity AIFs or AIFs in general?
All kind of AIFs.
All kinds of
All
AIFs.
kind of AIFs.
So what are the kinds of AIFs, by the way? Because a lot of people might not even know.
I'll just come to that. So just to close this stream of thought, currently we are around, I think, 3.5 lakh crore of AUM already in alternatives, which is a big jump from, and this industry, by the way, started in 2012.
Okay.
So we are frankly now growing at around 40-45% CAGR. And the good thing is that there are a lot of very, very high quality fund managers who are now coming out with products. 5 years back, I didn't see such high quality fund managers. Now we can allocate to these fund managers, whether it's governance, whether it's performance track record, whether strategies which are meaningfully differentiated. Otherwise, earlier what we used to see was the same strategies that were being done on mutual fund platform were just replicated on the AIF, which frankly didn't mean a lot to an asset allocator. You have to have correlation which is much less than 1 for me to be able to allocate to you if I want the diversification vis-a-vis my core portfolio, which is now starting to happen. Yeah, so now coming back to the question that you asked, and I think it's a very relevant question. What are the categories of alternatives? So the way we divide those categories, there are 4 primarily. One is private equity. And I think private equity is reasonably well understood in India. I think it's also matured a lot.
Yes.
We have now seen 2 or 3 cycles. The international, very high quality fund managers are in India. Some of the domestic guys have done an exceptionally good job, but they also go through their own highs and lows. A lot of family net worth has also started to go into private equity. So for example, 5 years back, most of the family offices and rich people did not have access to private equity. But now, I think a lot of HNIs and rich families have started to get access to private equity in India. So that has also started to happen. The second category is private debt. Very unique, emerging asset class, not only in India, but globally. But what is surprising is that actually private debt has become much larger or is growing much faster than private equity globally.
Oh, really?
Yeah.
Okay.
And actually, even players like Apollo, players like Blackstone, players like BlackRock, players like Lone Star, you take each of them, they have become very, very focused on private debt. And I'm not sure about everyone, but most of them would be growing their private debt portfolios at a faster rate than their private equity portfolio.
Okay.
And mind you, this also happened in the wake of GFC crisis, where banks withdrew that space and a lot of these asset managers came in. And now we are starting to see this happening in India.
Got it.
So very few people have done this successfully in India and actually launched a very few products. We want to launch one of these products, and at some time we'll talk about it. We have already launched the product, the private debt fund.
You have launched a private debt product.
We have launched a fund, but there are a couple of other high quality private debt funds as well in India. But we think these funds can deliver equity-like returns, but with much lesser volatility than equity.
What is such a product? I mean, and how does this work? For example, can you tell us a bit about it?
Yeah. So when you think about, for example, equity, right? So there are listed equity, and there are private equity, right? What is private equity? Where you identify a very special situation, you fund a company at a much lower valuation, but you also add value to the company.
Of course.
Right? So private equity is not just giving money to the company. It is doing a lot for the company by being on the board, by helping the promoter think about the firm, by giving him your network, etc., etc. Now, to think about private debt, the framework should be similar. In normal fixed income, what do? You just give money. That's it. In private debt, you understand the situation. You work with the promoter. You put governance structures in place. You help the firm solve very specific problems of financing. Okay? And because those problems cannot be solved without skill, without capabilities, you are not only bringing capital, you are bringing capability. And hence you are pricing yourself much more than a pure fixed income instrument. But you're creating more value for the operating company than what a pure debt is doing. And hence the returns are superior to a fixed income instrument.
Okay.
So it's in some sense a mirror image of private equity. But what you get is debt-like return. So you don't have unlimited upside, but you're very well covered on the downside. So that's the beauty. For example, we do only EBITDA positive companies. So our EV to EBITDA after our debt infusion should never be more than 3 to 4 times. Our asset cover should always be more than 2 times. Now with that kind of a cover, I mean, your chances of losing capital go down dramatically. But if you are able to generate anywhere between 16 to 24% kind of returns, depending on, at what point in the cycle did you catch the company. Now you're talking about equity-like returns, maybe sometimes superior to equity returns, but with a lot of controls and covenants in the organization. So that is private debt. I think this will be an asset class that I think we should watch out for. In the next 5 to 10 years, I think this will become 10x of where we are right now. So.
Okay, and the series, we are calling it Where Do Millionaires Invest? Are the millionaire clients investing heavily into such products?
Yeah, so in the, as I said, in the last organization that I was running, we had raised around 20,000 odd crores in this fund. In these funds, let me not say this fund, in these funds. And I think there are a couple of other organizations which are raising a lot of money. So I would not say they're allocating a lot of money, but the incremental appeal for these funds has gone up dramatically in the last few years.
Okay.
And I see that happening in an exponential way over the next few years.
Okay. So that's interesting. So thanks for that. That's it's something new. I don't think we've heard about this too often. So thanks for bringing that to
So
us.
just to close the framework, because the first question was, what are the 4 segments? So private equity, private debt, hedge funds, and real assets. So these when you
Real
ask
assets.
real assets. So hedge funds are, of course, everybody knows, or most people understand what hedge funds are. But in India, hedge funds are still struggling because of the regulatory
Sure.
frameworks, which are not as, I would say, amenable for the for tax issues, for what is possible to do, and so on and so forth. And real assets are basically where you, instead of buying companies or investing in companies, you actually buy actual operating assets. So,
like a highway, for example.
like a highway.
Okay.
Absolutely. Like a highway, like a road. You can actually buy a port. You can buy an airport. REITs, InvITs, they're also part of the real asset spectrum, and they have also become very, very interesting to some of our high net worth individuals. And just now connect the dots. Yield and fixed income. That is what is driving a lot of these ideas.
Of course.
So of course we like equity, but
Yeah.
the volatility that comes with equity, you cannot allocate beyond a point. But a lot of these instruments, what they provide is returns which are superior, risk adjusted, but also a lot of stability to portfolios.
Sure. Yeah, and that's crucial as well. So Nitin, I am trying to understand that when we talk, what you are talking about in terms of fixed income is very different from the traditional understood fixed income thoughts that people have in mind, right? Which is buying a bond which gives you 6, 7%, 8%, etc., or a structured product which might have some more. This is very, very different kind of investing. You reckon that the size of these investments would grow, and are, in your current conversations as well, are people looking to open up purse and write checks for stuff like this in a big way?
I think so. See, every category which is new has to be discovered, and somebody has to drive the discovery. We intend to drive this discovery fundamentally, right? So, but what we are saying is that there are 3 or 4 high quality fund managers who are doing this job in India right now. And the kind of traction that we are seeing in private debt makes me believe that over the next 4 to 5 years, this is going to be a very large asset class. In fact, for a new asset class, the kind of reception that we are seeing, even for our fund, has been actually quite positively surprising to us. Okay. So I do think this is a kind of opportunity that people have been waiting for in India, because there are very few alternatives to traditional.
Sure.
And just remember that despite G6 going to 7.5, your FD rates are still 5.5%, 6%. So that gives that spread, which is essential for alternatives to drive assets. If you are able to generate anywhere between post-tax 12 to 14, it's a massive spread over what you can deliver in
100%. So it is. Yeah.
I do think it will become a very, very big asset class. That would be my expectation.
One more grain of thought that I've picked up from some of your peers is that the rich are have been since post-COVID very keen and have invested heavily in private markets. Is your experience similar? And how do you think it shapes up now that we know that private markets also have seen a bit of a reset of valuations?
So I think there is this, again, I'll take you back to asset allocation. I think every asset class is cyclical. Fundamentally, some are short cycles, some are long cycles. And one of the key fallacies of market is that people value recent performance too much.
True.
There's too much of anchoring around the past 3-year performance or sometimes even 6-month performance.
Sure.
I think private markets went through that, and I think especially in the unlisted space,
Precisely.
I think there was a lot of excitement in the last 1.5, 2 years. But what has happened, and I'll tell you something very interesting. It's all maths at the end of the day. It's a little bit of behavioral, but a lot of it is driven by maths. Just imagine companies that are saying that we will not be profitable for next 5-6 years, but we'll make profits after that. Brilliant companies driven by exceptionally high quality promoters. But once the interest rates go up, what happens is the value of cash flow 7 years out, 8 years out, 10 years out dramatically drops.
Sure.
Right? So it's not in India, but globally, every company, which was not profitable, but which was projecting cash flows 5 years, 10 years out, as the interest rates have gone up, have corrected by 30-40%. By the way, which it has to.
Yeah.
Because as interest rates have moved from 0 to 3.5% dollar, that is a mathematical correction that you need to go through just to discount the future cash flows today, right?
Sure.
And obviously, when the markets go up, they go up more. When the markets go down, markets tend to overreact. I think that is what has happened to private markets. Too much euphoria because the interest rates were low, prices were quite high, and some of the companies were doing very well. I still believe there's a lot of future in some of these companies. But the way I think some of these companies were sold in the HNI market, and particularly sometimes I feel in the retail market, was not good. I think at some level, the suitability of the client objectives vis-a-vis what you are advising, I think that is an important variable in this. And I think so there has been a little bit of disillusionment, if I can use the word, in the private markets. But I've seen these cycles many times. So yes, some of our clients did invest in private markets. Some of those companies have corrected, but they will come back. Some of these companies might or might not come back. So again, you have to discriminate companies. Private market is a large asset class. If you're invested in, let's say, stock, I don't want to get into stock, but let's say high quality companies.
Yeah.
I'm very convinced they're going to do extremely well. But let's say you are in companies which didn't have the strong moat around their business, or which did not have strong funding around them. Who knows how strongly they might be able to come back. We will keep a watch in that space. I think there's pain in the next 3 to 6 months. I think there's going to be more pain. A lot of people might think that this is the end of it. Where we come from, we feel it's not over. 3 to 6 months of enormous pain in the private markets. And then that will create an opportunity for us to identify some high quality stocks.
Interesting. So net, Nitin, safe to assume that from your perspective, where your clients might be looking to invest through you and where you might be inclined to invest them is keeping fixed income at the core, and then everything else becomes satellite, but largely fixed income led.
Fixed income is a core driver for sure. Depending on your risk appetite, we want to start going a little more aggressive on the listed equity space as the markets keep on going down. Alternatives we are always excited about, but the core idea, and you're absolutely right, this is the satellite portfolio because alternatives cannot be more than 15 to 20%. But that also creates meaningful alpha. We are continuously looking for high quality fund managers. But the key driver is you cannot have the same strategy as a long only guy. Because for me, then I don't get any alpha because of nearly the 0.8, 0.9 correlation. I need 0.2, 0.3, 0.4 correlation for me to give diversification to my customer. So people who are able to create strategies which have low correlation with markets, for me, they are very interesting opportunities.
Nitin, thank you so much. This was really insightful, and we learned a lot about a lot of things that we don't usually talk about. So thank you for that.
Thank you so much, Neeraj, for having me here.
No, the pleasure was ours. And viewers, thanks for tuning in to yet another episode of Where Do Millionaires Invest?